Hey Bowtie Nation, Joseph Hogue here, and today combining two of my favorite topics, dividends and real estate, to show you the highest paying dividend REITs in the market, one with a yield of nearly 10%. And those of you in the nation know I got my start as an analyst for commercial property, and there's probably no other asset that has created as much legacy wealth as real estate. Investment property is not only great cash flow, but has built-in tax advantages and appreciation, something that's really hard to beat. Now, pros of investing in REITs is you still get that exposure to the upside in real estate, but don't have to scrape together the 100,000 plus to buy a property directly. REITs are tax advantaged for the companies, so they can pass on all that cash flow to investors, and you get some of the best dividend yields around. In this video, I'll reveal the 7 highest paying dividend REITs to buy right now. I'll show you how to find these and then share a warning on how to avoid the biggest traps in dividend investing. And before we get started though, I've got to send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. On a side note here, you can find all these stocks on the Webull app. Use the link I'll leave in the description below and get 3 free stocks up to $3,300 when you open and fund a new account. And on top of that, Webull is also running a special promotion. Get $5 in crypto rewards with your first cryptocurrency trade of $1 or more. Now, free is always great, but what I really like about this app is the stock simulator that allows me to test out ideas and track stocks before investing my own money. Now I want to get into that list of real estate stocks, so I'm going to wait to show you how I picked these and a few warning signs that you definitely don't want to miss. We're counting up to the highest yielding REIT on the list, but first is Iron Mountain Incorporated, ticker IRM, and its 5.4% dividend yield. Iron Mountain is the leader in physical record storage with nearly 1,500 facilities in 63 countries. It's a slow growth market, but that keeps the competition out, allowing IRM to dominate the market and push that free cash flow into expanding its data center and digital storage business. Storage and records management is still about 2/3 of revenue here, the pie on the left, with data center a growing part of the total. IRM also has a strong service segment with that higher margins to help boost the bottom line. Now again, it's a slow growth business, even with that data center component, but the cash flow here is more than enough to sustain that dividend plus price appreciation. Management has held the dividend steady throughout the pandemic, so I would expect an increase sometime this year, which could really help boost the share price as well. Analysts have a buy recommendation on the stock, though the average target price of $44 each is just under the current price. It's still got 17% to that 52-week high and could get there on an increase in the dividend. One Liberty Properties, ticker OLP, is a REIT I hadn't heard of before researching for this list, but it's a really interesting mix of property types and pays a 5.9% yield. OLP is a smaller REIT with just 122 properties, but also more diversified by property type than you see with most companies. Across 10.7 million square feet, about half the portfolio is in industrial property, but it also has a significant amount in retail and leisure. Now, of course, the pandemic hit those retail and leisure properties, with funds from operations falling from $1.98 per share in 2019 to $1.90 in 2020, and then 96 cents in the first half of last year. The business has started to recover, though, and it's got a healthy balance sheet with plenty of funding to pull it through. Occupancy has stabilized around 97%, and the company insiders own a full 22% of the shares of this company, a great sign of confidence in the stock. Just 3 analysts cover the stock with an average target price of $36 a share over the next year. Now that's about 20% upside on top of that nearly 6% dividend. Now I'm highlighting some of the best and highest yielding REITs in the market right now, but I wanted to show you how I found these so you can check to make sure they're still good investments when you watch the video. I used the Morningstar screener, but you can use just about any stock screener. And first I looked for REITs with a dividend yield of 5% or more. Now if this were regular dividend stocks, I might start a search for those above 3% yield, but you expect a little more out of these real estate stocks. I also filtered for stocks with a positive price return over the last 5 years. So don't rush to the comments asking why your favorite dividend REIT with a 19% yield isn't in here. If the shares lost value over the last 5 years, then it's not a great sign for what's to come. So I'm not just looking for high yield dividends though, but dividends that are increasing as well. So I filtered for positive dividend growth over the 5 years. Because the only thing better than a stock that pays dividends is one that keeps increasing those dividends. I also wanted to diversify our list across property types, so I limited it to only 2 mortgage REITs. There are a lot of other good MREIT dividend payers out there that would have made the list, but I wanted to put together a well-rounded portfolio in other property types as well. I really like the growth potential on this next REIT, Gaming and Leisure Properties, ticker GLPI, with its 6% dividend yield. The company owns 52 properties in 17 states, many without a competitor for more than 60 miles. Its casinos are operated by some of the biggest names like Caesars, Boyd, and Penn National, with gaming and over 15,000 hotel rooms. Besides the growth in gambling that we're just starting to see across the US, I really like the company's strategy here. It contracts with those operators on a triple net basis, so the companies pay all the costs, including maintenance. Now, strong contract terms means that GLPI has been able to keep 100% occupancy since its inception. This is another property type that got hit hard in the pandemic, but free cash flow is already on the way higher. The company generated $728 million in FCF over the last year, nearly double the $424 million in 2020 free cash flow and above pre-pandemic as well. 21 analysts here covering the stock, with 62% giving it a buy recommendation and 1 in 5 naming the stock a strong buy. The average price target of $53 a share is just 20% higher beyond that 6% yield. Next here is one I've highlighted on the channel before, Gladstone Commercial, ticker GOOD, and its 6.5% dividend. The company owns more than 15 million square feet at 122 properties in 28 states across the US. The leases are spread across 106 tenants in 19 industries, so this is another REIT with that multiple property types. About half the rent comes from office space, with another 41% in industrial properties and the rest in medical office and retail. Occupancy is held pretty well at 96.6%, and the average lease term of 7.5 years means that even a more severe recession should support the rent. While Gladstone doesn't have a history of dividend increases, it does have a long track record of paying it, and it's a monthly dividend, so you're going to collect that cash flow every single month. Analysts have a strong buy recommendation on the shares, with an average target price of $25 each, 12% higher than the current price. Another of my favorite REIT stocks here, with Arbor Realty Trust, ticker ABR, paying a very strong 8.2% dividend yield. Arbor is a direct lender to multifamily, senior housing, healthcare, and other commercial real estate properties. Multifamily projects make up 83% of the portfolio, so that's a little on the high side, but these are agency-backed loans, so definitely the safety that you want to see in a mortgage REIT. Arbor has grown that dividend by 16% annually over the last 5 years, and on sales growth of 20% a year. With the rise in residential prices, rents on multifamily should be rising as well, and loan growth should continue higher. The shares have produced a 30% annual return over the last 5 years, and analysts have an average target of almost $22 a share for another 27% on top of the dividend. We're coming up on two of the highest paying real estate stocks next, but you know what we say here in the nation, it can't all be rainbows and unicorns. There is a warning here with all dividend stocks, and it's that you just cannot just invest in the highest yielding stocks. Anytime you're looking for those dividend REITs or the other stocks, take just 5 seconds to look at that price chart as well and make sure that management isn't destroying value with a plunging stock price. It does you no good to collect that 10% or more in dividends if the stock price is going to fall by 15% a year. It's a sign of falling cash flow, and that's going to mean eventually the dividend gets cut. Now, in REITs specifically, you also want to diversify into those different property types. Investing all your money in office REITs or self-storage or whatever just sets your portfolio up for a crash if anything happens to that individual segment. Now, I've tried to diversify our list here, but just make sure that you're in at least 3 or 4 different property types in your REIT stocks. Next is one of those 2 mortgage REITs in the list, Blackstone Mortgage Trust, ticker BXMT, and its 7.9% dividend. The REIT holds 157 loans for a portfolio of $22 billion and originated $4.7 billion in loans just last quarter, so it's growing consistently and the dividend is fully covered by earnings. Just under half the portfolio is in multifamily loans, with another 29% on office space, but you've got some diversification here with the remaining third in those other property types and across the US and Europe. Blackstone did really well through the pandemic, with a loan-to-value on the portfolio never exceeding 66%, so this is high-quality real estate loans. It's increased earnings consistently, and book value has grown to just under $27 a share, which means the stock trades for a fairly cheap 1.15 times book. Analysts are split, with about half rating the share as a hold, but a buy rating on average and a target price of $34.29 per share, about 11% higher on top of that 8% dividend. Our top paying dividend REIT, actually the only one with a falling stock price over the last year, Omega Healthcare Investors, ticker OHI, and its 8.7% dividend. OHI is the largest skilled nursing facility REIT in the US, with 17 consecutive years of dividend growth. More than 3/4, 78% of the 944 properties are skilled nursing, with the rest in senior housing. The company is spread across the US in 42 states, along with 40 properties in the United Kingdom. Skilled nursing facilities were rocked in the pandemic, no doubt about it. Occupancy was down 13% to January 2021, but has improved 4% since then to about 74% occupancy. Expenses were up $23 per patient day, which has meant lower profits. But this is a segment of the market that is only going to grow from here. The population over 65 years old is expected to increase 44% over the next 20 years, and that's going to mean continued demand for these types of skilled nursing and senior living. The average analyst recommendation is for a hold here, but the average target price of $33.73 a share is 22% above the current price. I think this segment of real estate recovers quickly over the next 5 years, and a return to the pre-pandemic high of $42 a share would be a 52% return on top of the dividend. Click on the video to the right for how I would invest a $10,000 portfolio for insane dividends. 7 income investments with an average dividend yield more than 5 times the market. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.